Alright guys, welcome back. I'm just laughing at one of my intros. I'm just recycling them. I don't feel like making them. They take a while sometimes. Alright, first of all, not financial advice. Consult your licensed financial advisor. I'm not a licensed financial advisor. I'm not responsible for anything. Do your own research. Consult your licensed financial advisor. And do not invest anything you're not willing to lose or lose sleep over. Hopefully my sound works properly. Took a while to figure that out. I added a new mixer and it was a mess. Alright, so a lot's happened this week. And it started last week. So for the past few videos, I've warned this winter we're probably looking at some sort of correction in the stock market. The yield curve on the 10-year started popping again, just like it did back in 2019. Towards the end of 2019, right? The timing of things, and then you know what happened in early 2020. But back then, the repo market was going haywire. And I bet that's going to happen again. Okay. So let's talk about so I'm going to talk about the yield curve. We'll talk about some of the news. Metals broke out. The market dumped like 10%. We'll look at charts and TA. Nobody should be surprised. I anticipated this in the alerts. I put it out. I warned everyone. Where is it? Yeah, so New Year's started here, and then I started warning everyone. I put out that metals bottomed for now. I mean, I'll talk about that in a second. But yeah, I warned about all that. And Bitcoin, or the crypto, selling off with the stock market because they're completely correlated, unfortunately. And what is it? The NVT on Bitcoin for the Grayscale Trust has been negative for like 6 months or something. So they've been net sellers, not buyers, for a while. It started last year until now. So any correlation with the stock market means Bitcoin sells off and then everything else sells off in crypto land, except for maybe Hex. That seems to go up in a bear market. It's a nice hedge. All right, I'll make a separate video on that. I want to mainly talk about the stock market. By the way, if anyone who joined recently, there's like 2 of you, you have to check your email, because I send out an email once you get the report. And then this is my website. And then if you didn't get an email, you should have. You could contact me. There's like 5 different ways. There's Twitter, there's Telegram. It's easy to contact me. Email. All right. So this is the past week. It's not too bad, but I mean, Apple's down 5%. The stock market, that's like, oh my god, the sky is falling. Microsoft, Google down 3%. Tesla's down 6% this past week. What is it? Home Depot down almost 7%. I do feel like people are running out of maybe cash, or they're not willing to spend it because the prices of everything is going up. And recently I just went to the grocery store and nobody has a full cart except for me because I go like once a month. And I'm getting like dirty looks. I'm not even joking. People are looking at me like, why does this guy have so much food? How does he afford all this? I mean, I only go once a month or every 3 weeks, something like that. So I can see that. I could kind of see that people are hurting a little bit. I pick up on small things as I go about my normie day, right? All right. Where is it? Let me bring up. So here's my Twitter. You should follow me there. If you're on my YouTube, why not follow me on Twitter? I'm kind of active like all day, every day. I tweet a couple things every day. And you do see, oh yeah, another thing. Meat. It's hard to find. And I talked about all this, like months ago. What else did I want to show you on my Twitter? Home prices still pretty high, but they're gonna start coming down if rates are increasing, right? All right, here we go. Non-financial corporate businesses, corporate equities liability level versus gross domestic product. It used to be gross domestic or gross national product, something like that. Anyways, so stock to earnings versus GDP, like market cap, is it's way out of whack. Like the economy obviously isn't turning and producing more and becoming more efficient. It's just that the stock market is just, pretty much a bubble. That's all that shows. Oh, it's funny. Mortgage costs me 50% of my monthly salary. Yeah, I mean, if you have a very variable rate and the 10-year is spiking over here, that's when all debts come due. I am going to talk about towards the end of this video how central banks, what their plan may be. How it just came to me yesterday, and I want to talk about it. I haven't heard anyone talk about it. So it might be another thing I kind of came up with. In the metaverse, Walmart is also trying to sell NFTs, like virtual vaporware people, apparently. This was funny. TikTok video. She's like, wait a minute. We pay taxes like 100 times over, right? So you get, it's your earnings. Then you go buy something, then sales. Then if you want to sell it again, you have to, the person who buys it from you pays sales tax again, and it's over and over and over until they take, I'm surprised they haven't gone after people selling stuff at garage sales. They'll try. I mean, honestly, I don't think they will because they have no power at this point. It's pretty, the emperor has no clothes. Yeah, this is happening, I believe, mainly in very urban areas that are very blue because of the truckers don't want to drive into these areas because of a certain forced procedure that they want. And not just that, it's just the inconvenience of putting on just, coverings on your face that just hold back all that bacteria that you breathe into your lungs. Yeah, this is all over the US now. It's really starting to become evident, and people are getting scared. and politically, very unfavorable leader we have right now. Although I think he's hilarious because he's so bad or just non-existent. I don't even know who's running anything anymore. Check the receipt. Global food prices hit highest since 2011, adding inflationary pressure. Now, 2011 was pretty bad, but it spiked not prior, but like going into the mortgage-backed security financial crisis, right? And then it spiked right after because of all the QE they did 1, 2, and 3 back then. Well, what we did in the past 2 years now is like enormous compared to the QE back in 2008, 9, 10, 11. So to bring it back down, the prices of goods, they have to raise rates, but they can't. That's what's funny. The Fed's trapped. They can't do anything. If they raise rates, everything blows up. But you know what? I think I figured out what they're gonna do. I'm gonna tell you guys. So, and then you have protests, right? Now this is the bloodline. If the truckers stop, everything comes to a complete halt. No gas, no food, nothing. It's just, and Mad Max. But you know what? This is the way. This is the way. If you want your powers to be, or the people. By the way, I hate saying powers to be. They don't have power. It's just all an illusion. And these heroes right here, what they could do is make them bend the knee very quickly, within a week. Because once everyone gets really pissed off, like there's nothing they could, like it's game over. And then we could go back to 2019 or live like the Floridians, right? The people in Florida or Texas or some of the red states. Everything could just go back to normal. Although it won't. Because nothing can go back to normal because the economy already crashed when they locked it down. It was going to anyways, but I talked about the timing and I believe it was all predetermined and everything. But at least we could start rebuilding. But I mean, the music hasn't even stopped yet, so it's too early to even talk about that. But this does need to be done because if the truckers, if everyone just goes along with this, it's endless. We're gonna end up like Australia, all right. And then what comes after that is mass, just dystopian starvation. I don't know, hell on earth. So, but we already won. It's just we're going through the motions now. All right. What else? Well, that was a funny meme. See, they're already buckling. It's already over. All right. So let's get to the news. All right. Stocks puke overnight gains, tumble back to key technical support. BofA predicts Tesla EV market share in the US will collapse from 69% to just 19% by 2024. Yeah, if only someone could have, predicted that. I made a whole video on it. Nobody watched it because everyone's a little fanboy. They want their little electric golf carts, super nice fancy golf carts. Yeah, they're fast off the line, I get it, but it's not sustainable. It's not. You know how much energy goes into extracting very rare, very finite resources to make giant lithium batteries. Like, take your cell phone battery and make it the size of like a coffee table, or probably I don't even know how big they are, but um, it's not sustainable. I mean, it's great for mining stocks, but especially polyprecious uh mining stocks because they extract all sorts of metals, which go into computers, TVs, EVs, and everything that this new Green Deal reset thing they want will need. Ironically, I feel like they want all the resources to come from Asia, so we don't deplete our own. That's probably what they've been planning. That's why, but at the same time, the U.S. is completely then dependent on them, and then that kind of answers their other goals that they want, which is obedience for us to live like in Asia, where your face is getting scanned every 5 feet you walk, and your everything is just track trace database, right? But so it's like getting two birds with one stone. You get the resources, and then you get absolute power over the sheep, right? It's not going to happen, but that's what their plan was. So, anyways, EVs not it's not a reality, guys. I mean, right now we can't even get normal new cars in the U.S. because of the semiconductor shortage, right? And that's for uh, petroleum-based vehicles, right? It's not even for all these electric vehicles. And not just that, guys. I've talked about it. The battery, 7 years if you're lucky. You can't even drive these vehicles in a four-season uh, region where you get winters and summers. When the climate changes back and forth substantially, it destroys a battery's capacity to hold electricity. The temperature, the extreme changes within the temperatures. So then you're going to be replacing a battery every 5-7 years, and that costs probably like 1/3 or half the value of the vehicle. That's like getting a transmission every 5 years, or getting a new engine, basically. All right, so here's what the future is really going to be. It's hydrogen. What is this? I don't know. There was an article where Amazon Bezos was thinking about buying hydrogen fuel. So you could power your home, you could heat it, you could create electricity, and hydrogen comes from water. All right, and that'll be the future. I've already looked into a few companies, but it's a little too early for that. I have a feeling the bigger companies are going to buy them out, and then like Bezos, right? So you just kind of have to watch out for that. All right, so Morgan Stanley turns even more bearish as accelerated Fed tightening sparks bear market. Goldman's David Kostin, by the way, this was authored by Tyler Durden. All right. Goldman's David Kostin, who has been uber bullish throughout 2021, even though we learned yesterday that the bank was quietly selling harvesting billions in stock positions for a third consecutive quarter. So inflation, an economic and political problem, and politically it's really bad for current admin, right? And again, I've said this many times. The market's dumping now, right? They've got to juice it back up for summer and fall this year. So I believe that they're gonna let the correction happen now, right? They're gonna say that they're gonna raise rates to stop inflation because people are complaining about inflation. It's all over the place, and that might psychologically work for like a few months, 6 months, but then they're gonna turn back on the printing presses and they're gonna stop tightening, or they're not even gonna start tightening. I don't know. But I mean, if they start tightening, maybe uh, 25 basis point one and done rate hike if they're lucky to, but I don't know, guys. The market's already dumping. So they can't reinflate if it goes past, like, I don't know, 20-25% correction. Then there's no way for them to reinflate it. So whatever they're gonna do, they're probably gonna do it by like before March, and then it'll be over with, and then they gotta reverse course. But I'm gonna talk about what their plan really is. So again, it's gonna be more smoke and mirrors. But I'm telling you, I haven't heard anyone talk about this. So yeah, it's 7% according to their data. It's really like 14. And as Biden just said during his press conference, it is appropriate for the Federal Reserve to recalibrate the support that is now necessary to fight inflation. So expect the Fed to keep pushing until financial conditions tighten. What all that means for equity markets is obvious, but just in case if it isn't, Wilson explains valuations will have to come down this year via a combination of higher back-end rates and higher equity risk premiums. And so the changes to the bank's Fed forecast simply mean it's likely to happen faster now, making a hand off between lower earnings and higher earnings less seamless. The faster taper and hike schedule brings this valuation risk forward to the first half of the year, and considering that the S&P is now just above 4,500 and could drop below 4,400 tomorrow, one can add that the valuation risk has been brought forward to this month. Furthermore, given that much more aggressive timetable for quantitative tightening, we could even see an overshoot to the downside of this. Wilson thinks, blah, blah, blah. Yeah, I mean, I told you guys this was going to happen. The reason it didn't happen like earlier is because I feel like the big players on Wall Street wanted to offload their stocks this year, so they needed a few weeks, right? Approximately 3 weeks to unload their stocks, and now they took profits for tax purposes, and now they're pulling the rug. They're like, all right, let it drop, because margin is at record highs for all these brokerage institutions, meaning all the retail investors margin accounts are over leveraged and they're all long, which usually is a good time for the big players, to play, not whack-a-mole, but it's a good time for them to take profit and let the correction happen, and then they'll buy the dip as soon as the Fed reverses course. The current projected PE for the S&P 500 is 18x by the end of the year. This target PE assumed a 10-year Treasury yield of 2.10% and equity risk premium of 345 basis points, with our new rates forecast of 2.2% by Q2 and a much more aggressive timeline asset purchase reductions. We think the equity risk premium could easily reach 345 basis points. All right, blah, blah, blah. None of that matters. We'll look at the charts. I'll tell you guys where it's really going. But line, blah, blah, blah. There's massive meltdown in the Nasdaq stock. So the Nasdaq, here's the Nasdaq up top, right? This black line. Well, the blue line is underlying stocks, like the smaller caps, the mid to small caps. It's just the large caps that are keeping the index up, and the index funds are keeping it up. Like I've said in the past, everyone's retirement fund just goes into a basket of index funding, thanks to Ray Dalio, and most of that money goes into derivatives, but it also which an index fund is kind of a derivative, but a lot of that goes into the major corporations, which are suppressing us and trying to destroy humanity. But besides that, uh, that's why it keeps the index high, while the companies within the index, their individual stocks are just crashing. So that divergence, right, shows you that there's something really, really fundamentally wrong here. And I wouldn't be surprised if, I don't know, a black rock is buying it, artificially keeping everything up because they have direct access with the central bank, and they get a lot of you know uh, they buy bonds, but they get a lot of fiat, like a lot, right? So that's how the QE is off rolling month over month through that institution. And I'm not saying anything. I'm just assuming that I'm not accusing anything. I'm just saying I don't know, maybe something like that's happening, because that also ties into the repo market and the over the counter market, right? Which George Gammon does a great job explaining all that, but I'm not doing it. It's very complex, and there's no point. It's just no money's moving around like left, like back and forth nonstop, and it it has an exponential through fractional reserve lending. It has an exponential uh it like branches out, and there's multiples of the money. Okay, so the bank goes, buys bonds, the central bank lends out cash in the repo market. The institution, right, or the bank takes it, and then they go and buy bonds, and then they get even more cash from the central bank, and then they could go and buy index funds or whatever, or corporate bonds, and then the entire damn thing just goes higher and higher, and it becomes a giant bubble. And honestly, it's not that different from mortgage-backed securities. You know what was worse than mortgage-backed securities and the ninja loans and all that during 2008? It was like AIG and all the insurers who insured the entire thing, because of the triple rating they got, triple A rating from the rating agencies, because those people are your typical, like, government employee bureaucrat, and they're just looking at retirement and getting maybe a cushiony job after uh, retiring from their public service, right? All right, that was a mouthful. I digress. All right, let's look at RoboBank. 2021 showed the Fed has no clue. I think they do have a clue. It's just that they have to. I'm gonna tell you guys their plan. I think I know. All right, the Fed has made a remarkable pivot around the turn of the year, dropping the transitory narrative and squeaking like a born-again hawk. Recent testimony, speeches, and interviews have made it clear that the FOMC is gung-ho and ready to start hiking in March, unless we see a setback in the real economy. Yeah, you think? I actually, last jobs data was just horrible, but it was really bad. I didn't see it on my Twitter line. I, I think it was not last week or the week before. We expect that the Fed to hike each quarter this year. Balance sheet normalization is also likely to come soon. In fact, we expect May to be the first live meeting. Are they being sarcastic? They're not. They're gonna pretend, and then something's gonna happen. Maybe around Eastern Europe. Maybe down in the Pacific. South east, right? Taiwan. I feel like something's gonna happen because a lot is happening globally. I keep track of that as well. They need an excuse. The cold season, that's done and over with. It's over. Um, I think it'll be the Eastern Europe. That'll probably be it. So they're gonna so that'll be the excuse to not do tightening. But the market's already dropping just the talks about it, just as they act like they're hawkish, right? It's all perception, guys. Here's an inflation chart. It's higher than the 1980s. It's the highest probably in a very long time. I don't know. Maybe ever. For the US at least. Here's the Fed's balance sheet. Record high, of course. Should be nearing 10 trillion pretty soon. Oh, here's that article. No. Okay. Correlation doesn't imply causation, but by Tyler Durden again. All right, largest technology companies that coincidentally have tracked unconventional monetary policy. That is hard to argue against the notion that central bank policies have been a big contributor to an incredible run for the sector of over the last 6 to 7 years. Indeed, as the chart below shows, the only notable setback for the gigatech space was when global QT arrived in 2018. However, briefly, just don't show this to the handful remaining macro tourists who are still so clueless. They actually argue the Fed doesn't dominate every aspect of the market while bizarrely still claiming to be finance experts. Yeah, so this is the FANG index and all that. We'll look at charts in a little bit. Why did I look at this? The Fed assets to GDP could decline to its pre-COVID level by the end of 2025. What? No, that's not going to happen. So these articles think that they're actually going to raise rates. I There's no way. I mean, the economy would just explode. All right, by Larry McDonald, we are in the early innings of a colossal growth to value rotation. I've talked about this for years. Everyone, I think so all the stocks that have been doing really, really well, all the SPACs and all the nonsense, that's gonna go away. We've already seen Uber and a lot of and what is it, Airbnb and all kinds of other stocks just do horrible because they don't make they don't have profits. They don't even have good revenue to earnings. But everything's based off of future growth, not current growth. Amazon was like that as well for a while, and they ended up doing very good because they pretty much became like a giant monopoly and like took over. Anyways, I'm talking more about like maybe Zoom or like these big tech stocks, right? Uh, Apple, this and that. I think those are gonna have a deeper correction. May not make new highs for a while. Um, and then capital will rotate into more basic necessities types of value plays, commodity based, lumber, agriculture, energy, stuff like that, infrastructure. Um, Now they didn't get to pass their infrastructure bill, but they're gonna try to do it before the for the midterms because things aren't looking good for them, right? And I don't know if they'll even be able to. If they don't, I don't know, guys. They're gonna have to come up. Janet Yellen's gonna have to come up with a plan to do helicopter money somehow without it having to pass if there's gridlock. But they might all pass it. I don't know because the current again, guys, Team Blue, Team Red. In the end, they all bend the knee to not their constituents, but their backers, right? The big money, Wall Street and corporations. Here's a Nasdaq 3% drawdown probability. Let's look at charts. All right, here's Bitcoin and Ethereum on the right. I do think they're gonna bounce. Not sure if they'll make an all-time high. They could, but some sort of bounce. These are weekly charts. I'll talk about this in my next video, but like I said, Bitcoin is sort of correlated to the stock market. So if the stock market bounces tomorrow, maybe ends this week, and today is actually Wednesday night. So we have Thursday, tomorrow's Thursday. The week will probably end higher for the stock market. That's what I'm thinking right now. But then the correction will continue probably halfway through next week and so forth. I'm believing. But so cryptos will probably get a nice bounce here and then also correct with the stock market. As of now, that's what I'm thinking. Here's Hex. Looking very bullish. Nasdaq Composite is right here. Dow Jones, US dollar. I'll talk about the DXY. So for the past few weeks, I've been telling my private members I'm hedging my portfolio. Before the year was over, I took some losses on some stocks. Because it's a strategy. You want to realize losses sometimes, especially on leveraged positions. So I did that because I was expecting a correction, and then I rolled that over into I rolled some of it over to hedge my entire portfolio with the VIXy. Or you could do it with the VIX, but I use some call options, and I also buy the shares outright as well to hedge my entire portfolio against the correction, because I do have margin accounts. Okay, if you're not experienced, you shouldn't have a margin account, but apparently they start everyone off with a margin account these days, which is insane. That's why, like, you guys need to know what you're doing. If you don't get a margin account, because with time it eats into your principal. So you'll go and sell stocks, and then you're like, hey, wait a minute, this was like worth 10 grand, but when I sold it, I only got like 4,000. Well, that's because you have a margin account. There's interest on it. All right. So what are we going to talk about? Let's look at the VIXy. It's a nice move up. And I bought it like just a few days prior, a week prior to this bottom low. I bought it right down here around 14 bucks. Popped all the way up. I got a nice 18% pop. With the call option, that's like 180% gain. Well, it was for me at least. So, is there more for the volatility index? Yeah, I believe so. I think it's gonna. Oh, it looks like it wants to really break out here tomorrow. Might spike up and then sell back down, and then I'm gonna add to that position for February and then going into March as well. But that is all dependent if the stock market bounces tomorrow. So you kind of have to watch out for that. But you get a nice move up. Maybe around, it'd be nice to break 20 bucks. Depends how sharp the correction will be, the velocity of the correction on the equities. Here's the 10-year yield. This is why the market is correcting, right? Because the Fed is talking hawkish because they're trying to calm people's inflation expectations, because your average normie is starting to realize, like, why are my groceries double the price from like 3-4 years ago? This is insane. It's hurting me. I can't, like, I have no money at the end of my paychecks, Gas is this is why a lot of people aren't even going to work anymore. It's like almost not worth it for those low paying jobs. Uh, if you have to if you have to drive like 40 minutes to get to work, buy a lunch, like how much of your paycheck are you really even keeping? You know? And it's unfortunate. It's like the worst thing that could happen to people's standard of living, but if people don't pay attention, let crooks take their future, take everything from you, which is really just the big companies, guys. That's where it's all going. And no, we do not have a free market. This is a mixture of state and corporate, right? That's what we have. And there is a word for that. And if I just don't want to say keywords because, this is the world we live in because we have too many cowards. But they're getting they're getting bailed out while everyone else is getting inflation. Anyways, the 10-year yield, big cup and handle, right? So I drew this. Actually, I made this a while ago, like last year, beginning of last year. So I put that around. This was 2020 that I made this. Between 90.9 and 1%, that's neutral. Things start crashing between 1% and 1.6%. Or the market gets a little shaky. Let's say that. Because it didn't crash. I was kind of wrong. So let's move this up. I think things are going to get real shaky. I mean, just at 2.6%. Because if you zoom out, there's some, see how the price, this is educational, remember? So I'm teaching you guys stuff. See all this price action right here? So the bond traders are looking at that, I'm assuming. And that'll be major overhead resistance, but not really. I mean, this is yield on debt. But I think it ain't going above 2.5%. Once it gets above, I mean, even at 2.25%, where things are starting to blow up, but the housing market, everything just blows up. Just at 2.5%, I believe. 2.5, 2.6, somewhere around here. Game over, I believe. All right. And we're not that far off. I mean, just in the past just in the past 1, 2, 3, 4, 5. So in the past month, yields have risen 40%. That's a lot on the 10-year, for the 10-year bond. That means nobody wants the bonds. What are bonds? Just giant baskets of fiat currency, basically. IOUs, right? Another reason why I think the DXY is weak. And I don't really want to get into the milkshake theory thing again. So the DXY is weak even after this market correction, which is different. So it's decorrelating from market correction. So people are, that is strange because usually knee-jerk reaction is to get into dollars. So where's the money going? Are they buying bonds? Are they pushing up the yields? Maybe. Or they're not. Actually, they're not buying bonds. That's why yields are going up. I do have another chart with the tips. Here's the tips chart. I don't know. So tips are inflation adjusted U.S. bonds and treasuries. Oh well. Yeah, anyways, this is a cup and handle. It's breaking out already. Let's go to the 4-hourly. I think they're going to do some yield curve control, push it back down to retest the 1 point. I don't want. Yeah, maybe the 1.6, and then yields will probably go up higher. This is the free market trying to normalize everything, but they're not going to let it. They don't want to let it. So maybe yields will drop tomorrow, Friday, Monday, and Tuesday, and then they'll spike back up again and go even higher, heading for that 2% target. 2% breaks, and it's a quick shot to like 2.5. And at that point, the market is dropping another 15-20%. We're going to get a nice 20% drop from the all-time high, I believe. It's just that, it's not going to play. It's not going to be dropping every day here. Here, let's take a look at the FANG indexes on the left. Nasdaq is on the right. These are weekly charts. So on the weekly, the FANG index actually broke the 50. That's a 50. Could be a 52. Oh, broke the 50. So it's probably at the 52. So it's pretty much on support at the 52 MA weekly, right? Take a look at the daily. Oh, there's my blue line. The blue line X is major support, or it should. 200-day, if it fails, which it did. So the Nasdaq has already broken through the 200-day moving average, which is a big deal. Correction's been 13% on the Nasdaq, almost 14. Pretty bad. So a little more to go. I mean, right to my blue line, which would probably be a 15%. Oh no, I'm sorry. This is the FANG index. That's what I was just looking at. The FANG, not the Nasdaq. Here's the Nasdaq. Nasdaq isn't as bad. Dropped 11%. Alright, so here's all the major indices. Nasdaq, S&P 500. FANG index on the right corner here. Dow's in the left corner here. The Russell 2000 doing really bad. Broke major support and just free falling right now. So the Russell 2000 is domestic, smaller to mid-cap companies for the U.S. Oh, by the way, with the thing going on with Canada, I mean, Canada is going to suffer way more than the U.S., but it's still supply chain interruption. It's just like the worst time to have it. They're going to blame it on the weather. Some bullshit. You know what? That's the new thing. Weather. It's changing. Guys, every time a volcano goes off, and recently a huge one went off, there was footage of it from space. You should take a look. It looks nuts. Yeah, every time one of those goes off, it like puts out into the atmosphere like probably a couple decades of all of humanity driving around and polluting. Just one of those mega big volcanoes. But every year we get, maybe a handful every decade, a couple hundred going off. I mean, not the big ones. The big ones, like the one recently happened, probably just like maybe one or two a year, not even. Anyways, the Vanguard Global Index is on support. It fell the least, the global one. Interesting. So this is mainly weakness for the US. But you're going to see it globally. It's because all central banks, all economies are in the same boat. But in the US, it's Americans haven't seen inflation like this abruptly happen like in their lifetimes. So things can get real shaky. I still don't think it's too bad, but um, by the end of summer, it might be really bad. So the Dow Jones should hold up better than the rest because it's supposedly supposed to be more industrial jobs and commodity based. And like I said, value stock. That's where all the value is right now. The value stocks are no longer in the tech companies, but now it's shifting towards commodities and for your basics, which is what I try to specialize here, and that's what I've been planning on for years now. To be in to catch that wave because it's going to be enormous, and I'm going to post all of the mining stocks that have done the best in my portfolio last year, which was a horrible year for all well, not all commodities, just gold and silver, but it was a great year for copper and all the other commodities. Lumber did really well, right? And all that. So I'm gonna post that. Here's S&P 500. Surprisingly, did not fall all that much compared to the Nasdaq and the Fangs. Only 6%. So the Dow and S&P are holding up better than the Russell 2000, which is weird. And I maybe the Russell 2000 is getting hit hard because small businesses, well, they've been devastated the past 2 years because of lockdowns, but they're probably really suffering because of the cost of goods going up, and they can't find people to employ because people don't want to work for shit wages or diluted wages from inflation, right? So the S&P and the Dow will probably hold up better, and I'm I probably should have shorted so I could go long with a inverse ETF to get gains off of the Nasdaq selling off, and I'm going to look into that for the private group. All right, here's agriculture. Looks strong. One of the members in the private group, veteran investor, he mentioned it literally at the bottom. I mean, this thing's gone up not quite 100%, but 90, something like that. And it's steady and slow, but it's, it's nice to have one of these in your portfolio because while other things are volatile and going up and down, you've got a couple positions in your portfolio steadily rising and keeping that margin for your account in the positive and the green, and your balance, nice, and then not in the red. All right, here's WTI, the purple, and this is gold up here with the candles. You can see the correlation between the two. Well, it's not always the same, but back here in 2008, when WTI went up, so did gold. And that makes sense because it costs more to mine it and produce it. The same goes for silver and everything else. So I do think there will be a correction in WTI pretty soon. Let's take a look at some of these energy stocks. These were great buys in 2020, and then I took profits too early. Oh well. Um, yeah, I'm looking at a correction in crude for the short term, And especially with if the stock market further corrects, it'll take the rest of oil down with it, and the entire energy sector really, and that'll be the perfect dip buying opportunity. And I'm looking to get back in on some of these. All right, guys. So here's what I'm thinking. What am I thinking? I am thinking that central banks, this is what their plan is. They're going to try to do tightening while at the same time doing QE in the background to prop up the markets as best as their ability as they can. And they're going to send out more stimmy checks. They need to give people money while tightening rates. Believe it or not, that's what I think they're going to do. Why would they do that? Well, if they tighten rates, the cost of borrowing goes up, but so does the interest rate on your debts already owed, right? So what they could do is raise rates to satisfy the bond market and the global bond market, so they don't all dump the dollar, right? But at the same time, they don't want the people to suffer tremendously and they lose everything as the market dumps and the rates go up, and then we get another housing crisis and blah blah blah. So the way they want to somehow avoid the pain is to just do helicopter money and give everyone money, literally, like do UBI and stimmy checks, and then people will have extra cash, and supposedly they should be able to, with that extra money, sort of pay their higher pay the higher interest on their debts already due. And I do think that they know that this can't go on for long, but they'll try it, and just to buy another year at the most, I believe. So here's my timetable that I'm theorizing, and I could be completely wrong, right? Can't always be right. But if the market, so for the very short term, maybe a bounce tomorrow, Friday, very short term bounce. Then in a few weeks or a week from now or whatever, a continuation with the correction, yields will continue to spike, and then the market's going to start dumping very quick and hard. Things are going to start breaking. And then maybe another event happens, I don't know. And then Powell is going to he's going to push back rate hikes. That'll be the narrative. And then the plunge protection team comes in. But they need a way to they need a though they need an excuse to sell more bonds and get more cash out into the system. I think they're going to do some sort of QE, like they'll do more buyback purchases. They're going to do it through the repo market probably, and then they're going to send out stimmy checks. I think their plan was to do another week or two of lockdowns just to have an excuse, but they're not going to be able to do that. So they're just going to say, well, everyone is getting hit hard with this new cold season, so we're just going to send out another round of stimmies or something. And that'll juice the markets a little bit, right? It'll put a bottom in. Then the market will dead cat bounce, and then they'll take the rate hikes off the table, and then something will happen. Let's say Eastern Europe happens, and then that'll be the excuse to provide some, to support the markets because of that or whatever. And they're going to have to do more QE, like pass another bill of like 2 trillion or 3 trillion, or they're going to try to spring. If they fail at doing all of that, like all of it, if they fail at like the UBI and all this, like if they just can't get trillions back into the system, even if they don't raise rates, the market will start rolling over at the worst possible time for the current admin, if that makes sense. And I don't think they want that. I think they want the music to play in the summer, like things to be all right. Because things can get destabilized very quickly, especially as inflation keeps rising and rising. So they're cure. Oh man, they forgot to mention this. We're talking about price controls, which leads really to more empty shelves. If you put price controls on any goods or services, what happens? You get a shortage of that goods and service. Because why would I sell something if I don't make a profit? Matter of fact, I might lose money if they do price controls, right? So let's say I'm selling milk or bread. Well, let's do bread. Well, if they put a price control on the bread and they say you could only sell it for $4, but it costs me $4.25 to make it with all the employee costs, insurance, utilities. Utilities are going up, remember? Energy costs, shipping, gasoline, freight, supply chains are breaking, just the cost of everything's exploding. Well, now that bread costs me $4.25, but they put a price control for $4. Well, then I'll just say, well, what am I going to do? I can't support everyone. I'm losing money. So I just stop making bread. And then the shelves will be empty. It's that simple. What else? What did I want to pivot into something else that was important. Oh, a lot of companies last year did not raise their prices because they actually believe they're economists. Every big company has an economist, or they just listen to the central bankers, Powell. And they were promised that inflation was in control and it was going to come down, and they were going to raise rates. Well, they no longer believe that, and they're raising prices now all over the place. And to make up for all that lost revenue and money they lost last year, because they took they took the hit for their consumers because they don't want their consumers to leave, right? Because when you hike prices, people leave. So they refused to do that, and then their profit margins shrank, and they're probably at the point where they might be going negative. So they have to raise prices anyways. Yeah, it's gonna be wild, guys. You think things are bad now? It's just gonna gradually get worse. Now, for that caveat, whatever. If the stock market takes a nice hit, 20, 25%, maybe even a 30% hit, it might give a bump to the DXY, and inflation might, because oil's going to go down, all commodities are going to drop with the markets, and that'll give you like a temporary relief to inflation. It might last a few months, maybe 3 at the most. And that'll be the perfect buying opportunity, I believe, to get these mining stocks cheap, super cheap. Recently, they rallied this week, but you'll get one more big buying opportunity, I believe. I could be wrong, though. It might just take off. But because, by the way, when they do raise rates, metals actually take off. That's literally what happened in 2010 and 11 and 12. Well, 9, 10, 11, 12. They were raising rates and metals went to the moon. All right. So, and by the way, the central banks are so behind the curve on inflation. Even if they did jack up rates like 5%, they're so behind the curve, it'll actually cause more inflation. And I talked about that in my last video, not the last one, but maybe the one before it. And it was actually a George Gammon video where this guy brought up the fact that if they raise rates, it'll actually create even more inflation. It's wild, guys. And I forgot. I don't want to get into it. I don't want to make this video like 2 hours long, but I'll get into it in my next video. I'll make a sticky note. I'll put it up here. Hopefully, I won't forget. Remind me. All right, guys. If you want me to talk about anything, put it in the comments section, and then I'll mark it down, and then I'll try to talk about it. All right, smash some likes. Go to my website, join the private group, and then you have to get an invitation email. Yeah. Till next time.